Are you feeling stuck in your local real estate market? Like the only deals you can find are overpriced, overhyped, or already gone? What if I told you the fastest way to grow your wealth isn't in your backyard? It's out of state. Smash that like button and subscribe because today I'm breaking down why the smartest investors in 2025 are going nationwide and how you can start building generational wealth without ever stepping foot inside the property. Section 1. Local loyalty can limit you. Let's face it, investing close to home feels safe. You know the neighborhoods, the contractors, the traffic patterns, but in today's market, safety can be a trap. Local familiarity can actually blind you to better opportunities elsewhere. Many investors who stick to their own zip code end up with mediocre deals that fail to meet their long-term financial goals. The most successful real estate investors adopt a data-driven approach. They prioritize return on investment, market fundamentals, and growth potential over geography. They understand that the goal isn't to be close to the property, the goal is to build a profitable portfolio. When you limit yourself to your local market, you're essentially fishing in a pond that may already be overfished. You might be competing with dozens of other investors for the same properties. Worse, your market might be saturated, overvalued, or plagued with regulations that make landlord life difficult. Consider this. The average rent-to-value ratio in high-cost markets like San Francisco or New York is well below the 1% rule most cash flow investors aim for. That means you could be collecting $2,000 in rent on a $600,000 property, barely covering your mortgage, let alone expenses. Instead, ask yourself the right questions. Are you looking for passive income or long-term appreciation? Do you want to rehab properties or invest in new construction? Are you open to markets where landlord laws are more favorable? Your answers should guide your geographic decisions. By expanding your scope, you can begin identifying markets that align with your investment strategy. With today's technology, remote investing is safer and more accessible than ever. Tools like virtual tours, digital signatures, and national property managers have removed nearly every barrier. Section 2. Better numbers, better returns. The key to building a profitable portfolio is simple. Invest where the numbers work. And often the numbers don't work in your own backyard. High purchase prices, low rental yields, and intense competition can decimate your returns. Out-of-state investing opens the door to more affordable markets where your money goes further. You can buy properties at lower prices, enjoy higher cash flow, and scale faster. For example, a $75,000 duplex in Indianapolis might generate $1,500 a month in rent. Compare that to a $750,000 duplex in Los Angeles pulling in $3,000 a month. Same rent, 10 times the cost. Let's break it down further. When you invest in undervalued or emerging markets, you capture equity on the front end and enjoy appreciation over time. These markets often have fewer investors, which means less competition and more negotiating power. Lower property taxes and insurance premiums also boost your net income. States like Texas, Florida, and Arizona may have higher taxes, but they're offset by strong rent growth and tenant demand. Meanwhile, places like Missouri, Indiana, and Ohio offer low taxes and solid yields. Moreover, new construction in these markets can reduce maintenance costs and tenant turnover, further increasing your returns. Companies like Rent to Retirement specialize in sourcing these deals, providing investors with fully renovated or newly built homes in prime rental areas with tenants already in place. When you invest based on numbers rather than location, you're playing chess, not checkers. You're thinking strategically, optimizing every dollar and setting yourself up for scalable, sustainable success. Section 3. Diversification is protection. Every investor needs a risk management strategy. Relying on a single market is like betting your entire portfolio on one stock. What happens if that market crashes? Diversification across multiple states is how you protect your wealth. Real estate cycles don't happen uniformly. Some markets appreciate while others stagnate. Some face job losses while others see booms in employment. By spreading your properties across diverse regions, you reduce the likelihood that one economic event can sink your entire portfolio. Environmental risks are also a factor. Investing in hurricane zones, floodplains, or wildfire-prone areas exposes you to physical and financial danger. But when you diversify, you can hold properties in low-risk areas that balance out exposure in riskier markets. Then there are political and regulatory risks. States and cities have wildly different policies. Rent control, eviction, and property tax hikes can erode your profits overnight. Spreading your investments across pro-landlord states gives you stability and predictability. Working with experienced partners like Rent to Retirement ensures you're not flying blind. They vet markets for economic strength, job growth, landlord laws, and tenant demand. Their goal is to help you build a recession-resilient portfolio that grows over time. Remember, a diversified real estate portfolio isn't just about spreading risk, it's about maximizing opportunity. When one market softens, another might be booming. Diversification gives you flexibility, protection, and a strategic edge. Section 4. Escape high-cost, low-yield traps. In expensive coastal cities, even seasoned investors struggle to make deals pencil out. The math simply doesn't work. High purchase prices, strict zoning laws, and rent caps make it nearly impossible to generate meaningful cash flow. Let's say you're in Los Angeles. You've got $1 million property generating $3,500 a month in rent. After taxes, insurance, repairs, and your mortgage payment, you're left with maybe $300 a month in cash flow, if you're lucky. One vacancy or major repair wipes out months of profit. Now compare that to a $150,000 single-family home in Dayton, Ohio, renting for $1,200 a month. After expenses, you might net $400 to $500 a month. That's real cash flow from a much smaller investment. Scale that across 5 to 10 properties, and you're replacing your W-2 income. Lower price markets often have landlord-friendly laws too. That means faster evictions, fewer restrictions, and more control over your investment. Plus, you can usually buy multiple properties for what you pay for a single home in a high-cost city. Some of these markets offer unique perks, opportunity zones, tax abatement, or economic incentives to attract investors. Rent to Retirement targets these areas specifically, giving you access to deals with built-in equity, low interest rates, and even cash at closing. Section 5. Avoid bidding wars and find better deals. Bidding wars are frustrating. You find a great property, run the numbers, make an offer, and lose out to a cash buyer or overbid. Rinse and repeat. This happens constantly in hot markets where inventory is tight and demand is sky high. But there's some good news. You can opt out of the madness. Out-of-state markets often have more inventory, less competition, and sellers who are more open to negotiation. That means you can buy below market value, negotiate repairs, and get better terms. In many of these markets, homes aren't sitting on the MLS for hours. They're there for days or even weeks. That gives you time to analyze the deal, inspect the property, and make smart decisions. Off-market properties, turnkey rentals, and pre-vetted listings are easier to find in smaller emerging markets. With the right partners, you gain access to exclusive deals that aren't available to the general public. And when you buy right, you make money on day one. Instant equity, positive cash flow, and appreciation of potential all work in your favor. That's the power of buying in a market where you're not just another bidder in a frenzy. Here's the game changer. Section 6. Buying, not just scavenging. Here's the game changer. When you invest out of state, you stop scavenging and start strategizing. You're no longer reacting to whatever pops up in your local MLS. You're proactively choosing where your money performs best. Strategic buying means targeting markets with strong fundamentals, job growth, population increase, rent demand, and business-friendly regulations. It means using your capital to its fullest potential, not stretching it to make a local deal work. With partners like Rent to Retirement, you get access to properties below market value, new construction rentals, and seller finance opportunities. They help you lock in low rates, reduce down payments, and maximize your returns. Many of their deals include rate buydowns as low as 3.99%, cash back at closing, and built-in property management. These perks make it easier to grow a portfolio without growing your headaches. Investing should be a business, not a gamble. Strategic buying turns you from a speculator into a wealth builder. It puts you in control, speeds up your timeline, and creates passive income that lasts. Ultimately, out-of-state investing is about freedom. It's about removing artificial limits, chasing real opportunities, and building a business that supports the life you want. It's no longer necessary to be physically close to your assets. Technology, property management, and expert partnerships make long-distance investing not only possible, but often preferable. So if your local market isn't giving you what you need, look beyond your borders. Explore markets where your money goes further, your cash flow is stronger, and your path to financial freedom is clear. Rent to Retirement is here to guide you every step of the way. From market selection to financing to property management, they provide the tools, support, and inventory you need to succeed. If this video gave you value, hit that like button, share it with a friend, and subscribe for more expert strategies to help you grow your portfolio and your wealth. Thanks for watching.